Hello, I'm Abhilash Narayan, investment strategist at HSBC. Welcome to the latest edition of India Brief, where we discuss our house views around Indian equities as well as fixed income markets. After a challenging first half, we are starting to see concrete signs of a turnaround in the macroeconomic as well as external backdrop for India. The implementation of UK-India trade deal, improved monsoon rainfall, as well as the FCNR deposit scheme have all led to an improvement in the recent sentiment around India. However, continued uncertainty in the Middle East, as well as a more hawkish US Federal Reserve, are risks that need continuous monitoring. Now, the Reserve Bank of India kept interest rates unchanged in its Monetary Policy Committee meeting on 5th of August. Despite the dovish undertone in the meeting, we continue to expect two 25 basis point rate hikes in the months of October and December, which should bring the repo rate to 5.75% by end of 2026. So what does all of this mean for financial markets? Well, firstly, we are neutral on Indian local currency bonds. Now, if you look at market performance, Indian bond yields have risen by around 10 basis points in the month of July as higher oil prices fueled concerns about higher inflation. However, the technical picture remains fairly supportive. Improved inflows from foreign investors, as well as our expectation of lower supply due to improved liquidity because of FCNR deposit scheme, means that the supply-demand picture is fairly supportive. However, our expectation of two more RBI rate hikes means that there is likely to be an upward pressure on yields, which leads us to believe that a neutral stance on Indian bonds is the appropriate one at the moment. We are also mildly underweight on Indian equities. Now, from a fundamental perspective, the earnings outlook for Indian equities has improved modestly over the past few months. Bloomberg data indicates that the companies in the Nifty index have delivered around 2% earnings surprise in the ongoing earnings season. However, the valuations for Indian equities continue to remain relatively expensive compared to other Asian markets, several of which are expected to deliver stronger earnings growth compared to India. So, from a positioning perspective, we prefer more domestically oriented and defensive sectors. Now, as far as financials are concerned, the FCNR deposit scheme as well as the uptick in credit growth are supportive for earnings outlook over the next few quarters. At the same time, the government's focus on domestic manufacturing as well as security means that industrial sector is likely to see above market earnings growth for 2026, and hence we are overweight on financials and industrials within the Indian equity space.